Hey, everybody. Welcome to the podcast. It is February 11th, 2014. Thank you for joining me. Appreciate it. Well, the markets all finished in the green today. The Dow Jones up 192 points, just off the highs of the day. The Standard & Poor's, by the way, Dow Jones just shy of 16,000. And that was actually the strongest of the major indices, up 1.2% today. Interest rates up on the day, the S&P 500 up about 1%, mid caps up about 1%. Small caps continue to lag. And we did have, of course, bonds selling off, volatility coming down. So really 2014 so far, we've seen kind of the last 4 or 5 days a mirror image of what we saw the previous 5 to 10 days. And as you can see from the chart here, V bottom, right? That's what this looks like, a V bottom. And we need to analyze this, and if you look at it from a technical perspective, we broke down below the 50-day moving average, then we broke down below the 100-day moving average. We've snapped back, and the first key was to get back above here, which we did. The next part was to get back above what would be considered kind of this right shoulder area, because that's kind of what I was looking at. We had the left shoulder right in here. We said potentially this could set up for a head and shoulders, and that still could be the case if you kind of draw this right over here. So we could roll over a little bit and head down a little further. So there's really a few different things that got the market going today. First was the Obamacare delay for small businesses, the employer portion. Then we had the debt ceiling. There's less hurdles, I would say, than what we had before, so that came out. And then thirdly, we had Janet Yellen, who was doing her testimony and really didn't say anything that scared anybody, I guess. And that's really not a shock. We thought she would basically sound like Bernanke, which is, we're gonna continue to taper unless, right? We're gonna keep watching the data, and stock market just kind of grinded higher all day long. But this is really the third strong day. We haven't had a blowout 90% up day, but we've had 3 very strong days in the last 4 days. And we saw this kind of reversal last week. I guess it was Wednesday. And we've really seen straight up since then. And everything that wasn't working seems to be working now. But the bigger question is, okay, now that we have some of this headline risk off, remember all the currency talk we had just a couple of weeks ago, the various emerging market currencies that were kind of imploding. You haven't heard about that in the last few days. And we've had actually what's looked like some positive news in the last few days. But we did get a pretty sharp, violent sell-off. And I told you that really the time to look to buy is when the fear abates a little bit. And the fear has abated. In fact, if we take a look at the volatility index, which had been over 20, the high was 21.5 or so. It's now at 14. So we've seen a big drop. And again, if we go back and zoom out here and you look back, when has been the time to buy the U.S. stock market? When we've had these spikes in fear. And so we got to a point last week where either something was changing, meaning we were going to have something much more dramatic than just a run-of-the-mill 4 or 5% correction, or it was getting to the point where we're going to start to rally. And we've seen that. Now does it start to fade again? And we certainly should expect, looking at this market, we should expect after this strong move up, some back and fill, meaning pull back a little bit, and then if it's going to rally, continue on from there. Here's a look at interest rates. They didn't quite get all the way back down here to 2.5, but they did bounce off this 200-day moving average, I guess. And again, if the data continues to come up better than expected, you would see rates, and the stock market does well, you would see rates kind of trickle their way back up again. I do want to tell you, if you didn't read the article about interest rates, go back on the blog, karleggers.com. Go look on there, because we did an article last week regarding interest rates on the long-term history, history from 1871 until now, and showing how, maybe we're more in a normal range for rates, and they're just going to stay in this 2.5%, 3%, maybe 3.5% range for a long, long time, and we won't get back up to 5 or 6%. So go take a look at that. But here's interest rates. Again, are we headed back up to 3%? Again, I think it will depend on not only the stock market, but the data that comes out. Take a look at oil. This is delayed a little bit, but basically this is sitting right out around $100 a barrel, and we're kind of at this double top area. But if that breaks on up, you're going to see some people squeezed, I think, because our economy, isn't strong enough, I don't think, to handle some of these costs going up, and we're starting to see some inflationary type things pick up a little bit. And we're going to put a chart up probably tomorrow on a positive employment indicator that you may not see a lot, and it's starting to turn up a little bit. And if that happens, the next thing you look for is, are wages going to start going up? And if that happens, then you start saying, are we starting to see little signs of inflation? But the inflation trade has worked so far in 2014. If you take a look at gold, by the way, gold has broken out. GLD has broken out from this little downtrend. So I would suspect that the next thing we should look for on GLD would be maybe in the 131 range, maybe not in a straight line, but if it can get through the 200-day moving average, you're looking at 131. What's interesting about today, I think, is that not only did we see, stocks work, but if you looked at the things that had been suffering during last year when interest rates were going up, look at utilities. Utilities are actually rallying even though interest rates are going up. So that's not something you see. The reason that utilities fell so much in May through July last year was because interest rates went up. If you take a look at the REITs, IYR, same deal. Look how much they fell. They fell in May and went all the way down and actually reached a low in August. So they'd fallen almost 20%. And then they've been moving sideways as rates have been going back and forth. But now they are actually up about 1/3% on the day, even though interest rates were up. So it's kind of a strange day where you had utilities, REITs, and rates up, and you had gold up, and you had stocks up. So either something has to give, or there is broadening out happening, where everything's starting to participate again. And that's what we would want if you're invested in stocks. You want the broadening out of the stock market. You want not only technology and financials to be going up, you want staples to be going up. You want retail. Remember, retail had just been decimated, broke the 200-day moving average. That has now bounced. You want retail going up. You want the home builders were interesting today because they actually were downgraded this morning, and yet the home builders were up about 0.4% on the day. And then, of course, you've got, discretionary stocks starting to come back. So a lot of those things in the last few weeks were really hurt that had to do with the consumer, that had to do with the retail. Any of that stuff was really hit hard. And now it's rebounding. So either people think they were wrong or it's just an oversold bounce. So we're not out of the woods yet in the big picture at all. But I would say this is where not looking at the charts comes into play to a degree, because looking at the internal strength of the market, it has told you that this has been a pretty strong rally. As I mentioned earlier, we haven't had these massive up days, but we've had 3 really strong days now where not only have you seen the buying expand, but you've seen the sellers just simply disappear. And so having said that, if you were simply looking at the charts and having stops and so forth, you probably got stopped out somewhere along the way here. And when you did, you get whipsawed, because not only did you get stopped out, but then here's the market rebounding. And we'd been talking about, not only on our podcast, but we had been talking about in our newsletter to our clients, that this was shaping up to look like a correction. And again, let's identify, what does a correction look like? A correction looks like news-driven, sharp sell-off that comes out of nowhere and starts heading down, and you get a big spike in fear. A bear market is a process that takes several weeks to several months to occur, and that's not what we saw. So we were of the mindset it was going to be a correction. Did we know how far or how deep? Definitely not. We were kind of in no man's land down here. It would have been more convenient to bounce off the 200-day moving average. But you can see that the 100 has provided support, and this one got a little bit more below it than usual. But the 100-day is still the moving average, I think, to watch, more so than the 50, which is really popular, and more so than the 200. Those have not helped you during this at all. Those have been, you can see the blue line. That means you've been getting whipsawed, whereas the purple line has been the one to watch. And so again, if you know it's a correction, then what you're starting to do is either don't do anything and ride through it, or buy the dip. But what you don't want to do is sell a bunch of things and get stopped out because certain moving averages broke. That's where you have to look at what kind of environment you're in first, and then if you want to use that trading technique, that's fine. If you're in a bad market, obviously you want to use a lot of stops. If you're in a good market and it's going down, what you want to do is either do nothing and ride through it, or depend on your comfort level, or like I said, you try to buy the dip. So to me, looking at the internal of the market, looking at the internals, not talking about the headlines and what Janet Yellen may or may not say today or Thursday. She's going to speak again. But not only looking at that and some of the headlines, but looking at what are investors doing. And there's no question that investors are using the dip to buy. And it could be because so many people didn't participate last year and they're saying to themselves, I'm not going to have that happen again. And so you have a lot of hedge funds jumping on any type of sell-off. That could be what's happening. But what I'm seeing right now is that this was a correction, and that correction, I think, is over. I think what we're seeing now is real strength coming back into the market, not just because the points are up. The points obviously coincide with that and are related to that. But, you could have a day where the Dow Jones is up 70, and you could have a very strong day internally. We so happen to have, these days we're up 150, 200 points, and we have a lot of buying and selling going away at the same time. So it's definitely confirming it. What I would look for now is, because we've had these 3 really strong days, look for some type of pause or pullback in some of the stocks you've been wanting, and then get allocated a little more at that point to equities if you're wanting to buy equities. I think that would be the time to do it. It's very hard to buy on the 3rd or 4th day when it's been going straight up, and that's really what we've seen. So be a little patient here. I was looking back, I think 2004, I'm not going to show you a picture of it, take too much time, but 2004, we saw some similarities to what we're seeing now, which is, these sell-offs and then a bounce, and then they may move sideways for a little bit. So it's not going to necessarily be a V that just runs straight up. I don't think we're going to have that. The only way we could have that is if it was just a continuation of 2013, and I think we're in a different market now a little bit. But so I think you'll still get time. But again, it's easy to say that if you have equities. If you're sitting there in a lot of cash, obviously you're going to have to think of some type of different plan to either get more methodically invested or just bite the bullet and buy a little bit quicker than what everybody else has to. I do want to also point out there was a chart floating around of 1929 to now. And everybody's saying it looks identical. It looks identical. You got to see this. It's identical. And they're basically going back to July of 12, right about this time frame. And they're pointing out that prior to 1929 crash, it looked just like this. We peaked, we fell, we rallied a little bit, and then it just plummeted and we had a crash. I want to caution you, look at these charts and really do your homework. What we decided to do was we looked at it not only logarithmically, but looked at the points. And what you'll notice is that from that same period of about, let's call it 18 months, the Dow Jones had gone up 100%. It had doubled, whereas the S&P had gone up about the Dow Jones had gone up about 20% during this little run. So, and again, we're looking at the S&P, but I'm pointing out that the charts look completely different once you put them on a percentage scale and a log scale versus just simply looking at the points and the pattern. And that's what people are doing. So could we have a crash? Of course, we can always have a crash. What are the odds of a crash? I think they're very low. And I think that this is, we can probably, and I've done it before. We've looked at some charts that look like other years, and that's why I'm pointing out that this correction, what I wanted to see was when were we at highs? We had a real sharp correction, and then it just took off without you, and you never looked back. And it's very rare. There is a little bit of back and filling here that takes place over time, but it got me thinking about the 1929 because that is a chart that's circulating right now around Wall Street that this looks just like 29 right before the crash. And while the pattern is similar, you can't compare a stock market that's gone up 100% versus one that's only gone up 20%. Obviously, the one that's gone up 100% has much more room to fall. All right. Hey, guys, thanks for joining. Don't forget carleggers.com, twitter.com/carleggers, eggerscapital.com, and we're on Google+, Facebook, and we also have our weekly wrap-up radio show that is on. We'll be posting on the site every week as well on Saturday mornings. All right. Have a wonderful evening, and we'll talk to you soon.